So, a warm welcome to all of you. We are meeting again this month as well. We meet every month. For some of you who are coming for the first time, we meet every month and we discuss an important topic on how to be prosperous, how to be successful, and how to be a wealthy person. Right. So, at BeSmart Wealth Management Company, it is our drive, it is our motive to ensure that we spread financial education on some of the most important topics and ensure that people become much smarter, more wiser, and start managing their money, start managing their finances much better. So that's our motive. So a warm welcome to all of you. Today we are going to talk about a topic that is very sensitive in nature, but one of the most affecting topic or affecting criteria for anyone's wealth. Okay, in the wealth creation journey, being debt free is an important parameter to have. If you are having debt and then you are on a mission of wealth creation, then at some point of time, the debt actually pulls you down, pulls you back, takes away some valuable time and takes away the valuable, the value that you have for time sometimes is taken away because everything like, money is not taken into isolation or not considered as an isolated thing. Money and time go together. Your time has value and money is directly linked with that value, right? This is the most important thing. So debt is something that pulls you down. Debt is basically a slavery of a free man, right? You take EMI, you buy. What is debt or what is loan? I'll just try to explain it to you in simple words. Everyone knows that it is a money that comes and I have to pay interest and EMI, but if you look at it from a detailed perspective, debt is basically the future money that you buy, that you take today. And you start paying EMI for that particular future money of yours from today. What you're going to earn in future, you take it today and you start paying, EMI from your current salary then. And hence, it is sometimes a very, very negative thing, right? Money that you have not earned, you're paying for it now, right? And this has something to do with what kind of loans you have. Not necessarily that all loans are bad. There are good loans and bad loans. We are going to talk about that in detail. But very often you see that people who have become slaves to the debt or have taken away their freedom. They can't think beyond a particular point. They are stuck in a job which probably they are not happy with, but they have to still do it because there is an EMI that is hitting their account every month. Right. So becoming debt free is one of the most important freedom that one has to achieve in life. More earlier you achieve, it is better. Most of the people are what you say, they don't even get into debt. And those people are in long term probably the most happiest people. Right. So having said that, let us see how can we be debt free by applying some strategic some strategies that will help us in short run and long run to be debt, right? So we are going to discuss this thing in a whole today, right? So why does it matter? Why talk about loans? One of the most important reasons is most Indian families live with multiple EMIs, and that is what is wrong. One loan is okay, but people who are living with multiple EMIs are the ones who suffer a lot. So loans are not always bad. They are unmanaged, but unmanaged loans are bad. Loans which you can manage are okay. There is a simple formula that we tell and educate everyone. Okay, we do a financial energy test or the financial fitness test of all our clients. And there, if you have done it, you will find that we don't recommend your EMI to be more than 25% of your net income. The minute your EMI, total EMI, goes beyond 25% of your income, that is the time it is an unmanaged loan or it becomes a bad loan, right? So let me just tell you, what is our goal today. Basically, it is to understand loan better, discuss some strategies to become loan free within a set of target, right? So as we progress in this session, I'm going to give you some very, very, very workable, smart tips that you can apply tomorrow itself and start the journey of becoming loan free. You can advise this to your friends, families as well, whom you know are in this trap of loans. You can ensure that even if you are not into loan, you should allow others also to be loan free. Right? So pay attention, and I'm sure these strategies will definitely make sense to you. First, let us understand that all loans are not bad loans. There are good loans and there are bad loans. Now, what are these good loans and what are these bad loans? We have to see. Now, a good loan is something that builds asset or income, right? It has a lower interest rate, very close to inflation, 7-8% rate of interest and 7-8% inflation. It's a good loan, nothing to worry. Because even if you're buying the future, taking the future money today, it is the inflation effect is not there. You're not paying higher than the inflation. It also helps you to improve your financial position. This is a good loan because many times what you do is, if you're a businessman, you need a strong backing of mostly the CC or the ODs that you take. They are good loans because they give you that financial backup. They improve your financial position so that you can do better in your business. So overall, any loan that is at a lower interest rate, any loan that has been taken to build an asset or build an income source, right, is a good loan. Now, what is bad loan? Many times we take loans to fund our lifestyle or consumption. That's bad. I know I can't afford a car, which is in the range of 10 to 12 lakh rupees, but I take a car that is of 20 lakh rupees and I take loan for that additional 8 lakh rupees because that is something that I need to fund for my lifestyle. I want a good lifestyle. That is a bad loan, but overall also, if it is fit, that thing, the EMI fits into maximum 25% of your income, it is still okay. Many times you take high interest loans, right? A very short tenure loan like credit card or loan from some unorganized sector which are at 2%, 3% per annum kind of a rate. You take it for a short duration, but it really hampers your financial position. And any loan that adds financial pressure, like that you are already 30% plus in your EMI and you take another loan that would add to another 5% of your total income, and your total EMI will become 35% of your monthly income. That will build pressure because everyone has to spend at least 60% of their income on some necessity things, household expenses, transportation, right? School fees, clothes, and minimum entertainment. You require 60% of your income to go there. But if you're taking a 30% plus EMI there, then you don't have any option left with you to create wealth or to protect yourself against some financial calamities, right? So good loans and bad loans, this is a destination. I'll give you examples. Examples of good loans could be a home loan is a good loan. Educational loan is a good loan because you're funding your skill set so that you can earn higher. Business loan, as I told you, is a good loan. These are always a good loan. Anything, if you see the above definition and if you see the examples, this matches. And that is what you have to be very careful of. You make a list of your loans and find out which are good loans and which are bad loans, from the things that I've told you today. Example, if you go to see for bad loans, is the bad loans are credit cards. I get points and I swipe credit card, but then I forget to pay it. Personal loans, bad loans, because there is no need to take a personal loan until unless you're taking that personal loan to fund the down payment of a property, maybe, right? Or that personal loan is, fulfilling these three criteria, like it is building an asset. It is, basically, coming at a very low interest rate, or it is helping you to build a, stronger financial position. Luxury car loan, anything that is a want is a bad loan. If you are funding a foreign holiday on a loan, it is a bad loan. If you are funding that, those tickets that you are buying for your foreign holidays on your credit card, it is a bad loan. So understand that bad loans sooner or later will definitely stress you. So this is the definition of good loans and bad loans, right? Now, how that traps us? It traps us, right? How does it trap us? See, understand there are five things that I'm going to tell you today, and you have to understand it very, very clearly. Now, this is something that will require your attention, but if you have understood it, in your future forever, you will always be alert to be out of debt traps. Now, EMIs, we all know this word EMIs, but what is EMI? How it is calculated? What is that happens in the EMI? EMI is a good word for bank, but not that very good word for you. EMIs are nothing but equated monthly installment. So what happens is they calculate the interest, for the whole tenure, and they spread it across, on each of your EMIs. But in the initial years, 60 to 80% of your EMIs goes towards only interest. That is something that we need to be aware of, right? If you are looking at EMI, I am paying an EMI, right? It is not that simple. Understand that the first few years or first few months of your loan tenure, you're paying maximum interest. And why does it matter? I will tell you further as well, but you have to understand this concept. Now look at this. I'll give you an example. Pay attention on this. There is a 10 lakh loan that you take at a 15% interest in a 7-year tenure. You've taken a loan for a 7-year tenure at a 15% rate and a 10 lakh rupees loan. Normally, this is the personal loan that people take. Now, this is the EMI, 19,944. It looks very easy because 10 lakhs is coming. A lot of people say, "Arey, main to bhar lega." Now, if you look at it, in the first 12 months calculation, I'm saying, how the calculations work of equity monthly installment. Out of the 19,000, 12,500 for the first month goes towards interest and principal only 7,000. 400 rupees. If you see totally in the first year itself, you have paid 1,43,000 rupees as just interest, which is approximately 14.3%. That's a very, very, expensive deal. So when you look at the, EMIs, this is one factor that matters the most, right? And hence, a lot of people who say like, I'll just, close these loans early, in this first 2-3 years only, but you have already paid a lot of interest there, right? If you see, this is 60% of your EMI is going towards interest in the first year. Yeah. And this is something that has to be kept in mind. So if you're taking a loan which is expensive, anything above 8% is expensive, I would say today, right? If you're taking a loan, anything above that thing, one thing is for sure that major portion of that EMI initially will go only towards interest. So understand equated monthly installments. This is one of the major factor that puts you into the debt trap, because you're not paying the principal, you're just paying the interest. You feel I'm paying an EMI, but half of the time, like every time, 60% of the money is going towards interest. Now, a lot of people feel that longer tenure is a good thing, because my EMI is lower. Instead of taking a 5 years car loan, I take it a 7 years car loan, or give me for 8 years. No. And this is how, we negotiate. We say EMI, is less now. EMI come aa gaya. Fantastic. We feel happy. That gives us a little, good feeling that my EMI is lesser. I've got a good deal. But that's not the way it is. I'll show you an example. Now, this is a 7-year loan, right? The same example. At the same rate, 10 lakhs loan at a 15% rate for 7 years tenure. In the first year, for example, you pay 1,43,000, right? For the 5-year loan, the first year interest is 1,40,000. Here you're paying 1,43,000. Here you're paying 1,40,000. But what happens is the principal, if you see, it is 95,000 here, and the principal here is almost 1,45,000. More than 50% of your money in a shorter tenure goes towards principal, and that's a good thing, because you're working hard and you're making the loan provider a little rich when you're taking the long-term loan. So understand this factor, right? Here it is 60%, here it is 49%. This is the interest portion. So if you take a longer tenure loan, if you are actually taken a housing loan which is 25 years long, you will be landing up paying a lot more, right? And I'm going to come to home loan. I'm going to give you strategies also for home loan. Right? So understand this. Longer tenure is another aspect that puts you into the debt trap, right? So ensure that tenures, if you can manage a shorter tenure, put a shorter tenure, if you're taking a loan. Like for example, this is what I'm saying. Like look at it further. The same 7-year loan, EMI would be 19,000. For a 5-year loan, EMI would be around 23,000 rupees. People can stretch, I'm sure, to another 4,000 rupees here. Total payment that you do for a 7-year loan is 16 lakh rupees, 75,000. Okay. And the total interest you paid is 6.75 lakhs. But for 5-year, total payment you do is 14 lakhs, and the interest that you land up paying is just 4,27,000, which means you have saved more than 2.5 lakh rupees, which could be used to compound your wealth, because that is the money saved. That money saved is money earned for you, right? And that is how you need to operate. Am I clear here? Do you understand why you should take a shorter tenure loan? Well, now look at it. At the end of the day, you have paid 24% more interest on that loan. It's a huge amount that is going towards funding something that you are, taking from your future income, right? As I told you, loan is the future income that you take today. Overall, psychologically also, I want to make you prepared that avoid this thing. If at all you have to take a loan, take it for a shorter tenure, right? Take it for a shorter tenure. Don't think that I will take it for a long tenure and then I will foreclose it. If you are thinking that way, as I showed you earlier, you will land up paying most of the interest in the first 2 years. Instead of that, take a higher EMI, shorter tenure, and don't foreclose it. Close it in the shorter period. You'll still be in profit. So you still save some interest portion of it. Now, the third part. A lot of people will not tell you whether it is a flat rate or a reducing rate. A lot of people will come and say 7% is the rate of interest. Flat rate basically is an illusion. Reducing rate is the reality. If someone comes and tells you 7% flat may sound cheaper, but 7% flat is actually double, around 14% reducing rate. So if you're taking a loan, please confirm, ask this question to anyone, whether it is a flat rate or a reducing rate. Reducing rate of around 10% is much better than a flat rate of 7%. Keep this in mind. This is one more trap. A lot of people get into loans and they think like, I have taken a very good deal, 7% interest, and then when they check, it is a flat rate, right? So this is another thing. Now, a lot of people also get into the fourth part of it. A lot of people actually get into a trap wherein what they do is they borrow more to repay. Yeah. it will give me satisfaction. Like, I can roll this, man. A lot of people are so smart in India. Like, there is no dearth of smart people. Think that, I will take this loan, I will repay the old loan. It's okay. I can bear that EMI now, but I will also have some more cash with me. You have done something very, very wrong if you're doing that, right? And that is what needs to be corrected. Don't get into that theory or don't get into that mindset that borrowing more to repay loan is a good strategy. It feels a relief, to reshuffle sometimes, but that's not a good strategy. Overall, ensure that your maximum EMI is not more than 25%. Because see, what you do is when you borrow a loan, new loan to repay it, as I shown you, if the loan, if the existing loan is covered up for 3 years to 3 to 4 years and another 1.5 year, 2 years is left, you have already paid interest. As I shown you, the equated monthly installments, you pay more interest in the initial phase. You have already paid the interest, right? Now only the principal portion is left. And then you take another loan, wherein again, for the next 2 years, you are going to pay more interest. So you are completely in a trap of, paying interest. How smart is that? Never think of, borrowing another loan to repay the old loan. Not a good strategy at all, because you will be landing up paying more interest. You might feel a short-term relief, but that's not a good strategy, right? So home loan, interest increases. When I say this, okay, many times there is something called, you take a floating rate interest rate, floating rate deal from a bank. So during the time when you have taken it, it is very low. It is comparatively very low than the other bank, which is giving you a fixed rate of say 8.5%. But you have got a 7.9% rate from someone else, which is a floating rate. Now, what happens is after some time, when the interest changes, and it normally changes 2 to 3 years, most of the banks, the RBI increases the rate, and here the effect is there on everyone. So, especially on the floating rate. Now, if the floating rate is given to you, okay, which is lesser, you feel nice in the initial phases. But over a period of time, what they do is the banks never increase your EMI. They keep the same EMI and they increase the tenure. This is very much applicable to home loans. A lot of people, now you go tomorrow and do one simple thing. If you have a home loan, please go and check what is the balance tenure and how much you have paid. Because I'm sure if the loan is running from last 5 to 6 years of yours minimum, okay, then believe me, at least 1-2 years of your loan has gone up if it is on a floating rate, because your EMI has remained the same and they have increased the tenure. Go and check this tomorrow itself. It will at least give you a relief that okay, everything is okay. But this is where most of the people continue in this trap. They just pay the fixed EMI. They feel like EMI to ja raha hai. I had taken it for 20 years. But now, because of the floating rate part, the tenure has gone up, and that is not good for you. Now, credit card defaults and minimum payment trap. When I say this, a lot of people feel that I am paying my credit card, right? Never default on credit card. And this is not something new that you are hearing. See, what is credit card? If I ask you what is credit card, why credit cards are good? See, when you go and take loans from a bank, does bank give you points? They don't give you points. Credit card, when you swipe, they give you points, they give you flying miles, they give you so many cashback options, or win some flight tickets or some vouchers, redeem it, some rewards. But for loans, they never give you. Why credit cards give you? Because credit card is a business of not credit. It is a business of default. They make money not by giving you credits. They make money. Credit card product makes money when you default. Understand the difference. Their business is not to give you credit and make money. Their business is to make you default, and when you default, they make money. Credit card is a big no-no. Okay, I know there are so many smart videos floating around these days, like, I've done this with my credit card and I've earned so much of points. Live life in a very simple way. Believe me, make it very simple. Don't get into this jugglery. Keep it very simple. Yeah, there are so many other ways where you can, instead of earning rewards, you can invest properly and pay it from your own money and get those discounts and coupons and air miles. Credit card is a business of default. A lot of people do minimum payment and they feel that, oh, I paid it. Psychologically, I'm comfortable. Like, minimum payment I've paid. If you're paying minimum payment of credit card every month, you're not even coming 1 or 2% less in terms of your debt amount. It is remaining the same and the interest is charged again and again. It is like you're working for the credit card company to ensure that they earn money, and you are working hard in your company to earn that money and give it to them, and the amount is just there, right? So credit card defaults, no, even if you have it, if you can wisely use it 100 out of 100 times, okay. But my experience is that anyone and everyone at some point of time does some mistake with their credit card payments, and or uses the credit card for something that they don't have to. And this minimum payment trap, get out of it. Right. So these are some of the debt traps that keep us as slaves. Right. And this is something, that someone has just asked you to explain something about gold loans. Gold loan also, gold loan against an asset is a good thing, because if the gold is increasing, it depends. But any which ways, the rate of interest normally is on a higher side. If the gold is growing, gold, even on the mutual fund, a lot of on the mutual fund or equity of their shares that they buy, they take loan. Those are okay, good loans, believe me. But try to cover it up as soon as possible. Gold loan per se, if you have taken the example of last 3 to 4 years, it has done well. It is not probably a bad loan in terms of the calculation. But what are you using it for? That also has to be considered. If you are using it for something to build an asset, okay, and hence you are pledging an asset and then taking that money to liquidate that, getting some temporary liquidity and then trying to reinvest it somewhere, excellent. But if you are funding, if you're pledging an asset and trying to fund a want of yours, not a necessity, a luxury, or something that can be avoided, or something that is not a necessity for you, maybe you have to take that conscious decision that no, I will not do it. Overall, in assets that are growing, and gold has been giving excellent returns last few years, at least couple of years at least. So overall, in calculations, you will be in a good deal. That is what my say is on gold loan, right? But same thing is in mutual fund also. A lot of people, need that emergency cash. So a lot of people come to us and say redemption is, something that I need. We tell them when market is growing, let us not redeem it. You take a small loan on that, and all the banks are giving those loans today, right? On whatever thing you have, whatever amount you have, of that 60% is given as a loan. So any growing asset, if you have to liquidate it, it is better you pledge it and take a temporary loan. But then that loan has to be for a particular purpose. See, gold is an increasing asset. So if you sell it, you take the money that time only, right? But when it is growing, if you can still pledge it and take that temporary liquidity, it's a good decision. So I'll give you some strategies here, okay, which will help you. Now, I've actually spoke about those 6 problems in the previous slides. Now, problems everyone knows, but having a strategy to tackle this problem is also very important. So let us look at some strategies that will help you to cover up your loans, or pay your loans, repay your loans, or become debt free as soon as possible. Number 1 strategy is prepayment strategy. Paying 2 extra EMIs per year will result into reduced principal, lesser interest, and faster closure. This is amazing strategy, and this is an excellent strategy for a home loan, right? If you have a long-term home loan, do this. Ensure that you pay 2 EMIs per annum extra. If your EMI is 50,000 rupees per month, try to pay 1 lakh rupees during that year extra. And you will find that at the end of the day, you are closing the loan much faster, you are paying lesser interest, and you are also reducing the principal much faster, right? I'll give you an example here to explain. Now, example of say 40 lakh rupees loan for 20 years, okay, can be reduced to 12.5 years only. From 20 years, it can be reduced and closed in just 12 years. If at all you are paying 2 EMIs every year, right? Look at this example. Now, suppose if you pay 2 extra EMIs for the 5 years tenure, you decided that I am going to pay for next 5 years 2 extra EMIs. So I'm going to pay 10 extra EMIs in next 5 years. You will see that the revised tenure from 20 years is become 17 years. You save 3 years, right? And you also save around 5.8 lakh rupees in interest. You save 3 years. Look at this. Without extra EMI, this is the thing. 40 lakh rupees loan, 8% per annum is the rate. 20%. Take a screenshot of this. If you need it. 20 years is the tenure for all. EMI is the same. Now, if you pay just 2 extra EMIs for next 5 years, you will end up closing that loan 3 years earlier. Plus, you will save interest of almost around 5.8 lakh rupees. And what you can do is after that 17 years, you are already prepared to pay that 33,000 rupees. Start an SIP for 3 years. After 20th year, you would have more than 10 to 12 lakh rupees extra with you. Plus, you have completed the loan and continue that EMI. And you'll still have around 10 to 12 lakh rupees extra cash in your hand. The same thing if you do for 10 years. If you pay 2 EMIs every year extra, you will reduce the tenure to 14 years. Around 6 years will be shortened, right? And 6 years means 33,000 rupees SIP will help you to make at least 25 lakh rupees more. You have taken that 40 lakh rupees loan The loan is over and you still have extra liquid cash in your hand of more than 20 to 25 lakh rupees, and you save an interest of 12 lakh rupees. This is the bonus benefit, right? Now if you do this for 12 years, your loan will be over. After, if you pay for 12 years, if you pay 2 EMIs, in next 5 months your loan is over. Like 12.5 years your loan is over, and you have saved 15 lakh rupees, and you have saved a tenure of 7.5 years, and you probably will have more than 30 lakh rupees as cash with you. The loan is over, you have saved 15 lakh rupees, and you can invest that money now, that remaining money, because you had already taken a commitment. You can invest that money and probably build your retirement fund here. Okay, for whatever reason you have taken. If you suppose it is a home loan, you don't need to complete it for, wait for it for 20 years. Just commit yourself for extra 2 EMIs. Now, extra 2 EMIs will work how much? If you are paying 13,000 rupees EMI annually, you will pay around 7 lakh rupees. But, and here 60,000 rupees, 70,000 rupees you will pay as additional EMI. Just 10% of the total EMI if you are paying 10%. So you just need to stretch yourself for 10%. I would give you a suggestion here, very simple suggestion. What you can do is you can start an SIP. Start an SIP of 5,000 rupees. If your loan EMI is 33,000 rupees, start a SIP of 5,000 rupees. You will get approximately around 60,000 rupees. And that 60,000 rupees, use it for loan tenure. Like paying those 2 extra EMIs. And it will not burden you. So you'll also have liquidity, because you are paying, you are building that fund through an SIP. If you can do it for 8,000 rupees, I'm sure you will be able to close the loan much faster. I'm just saying do it for 5,000 rupees. With 5,000 rupees also, you will be able to complete the loan in much, much shorter time. Does this make sense to you guys? How many of all those who have home loans, does this make sense to you? Or any one of your friends or family who have home loans, will you suggest this to them? This is a nice strategy. Prepayment of 2 EMIs. That's it. And see the calculations here. It is really going to save a lot of years of your committed paying those EMIs, and it is also going to give you save interest as well, and you will have that liquid cash for those remaining period to build wealth. Taking a 20 years loan, it's okay, because home loans normally for 10 years EMI eligibility वगैरह नहीं बैठता है. Although I had said that if possible take a shorter tenure, but for home loans it may not be possible, but then this strategy can work, right? So prepayment is a very, very good strategy. Pay just 2 extra EMIs and you will see the difference. Another strategy is snowball strategy. It is called a snowball strategy. In snowball strategy, this is just a typo error, paying 2 extra EMIs. What you do in a snowball strategy is, instead of focusing on interest rate, you focus on reducing the number of loans you have. Don't focus on the interest rate. Right now, don't be worried about the interest rate or whatever it is, Just focus that I have to come out of loans. I have 4 to 5 loans. I will make it 4 loans by the end of this year. Yeah, including all your credit cards. And have a strategy that smaller debts I'll finish faster. Smaller amount of debts, irrespective of the interest rate. Yeah. Don't go to pay the highest interest rate. Sometimes the permutation combination may not be in your favor. Sometimes the higher interest rate outstanding might be higher. Forget it. Just close the loan which has a lowest amount left. Do that. This will give you a very good stability in terms of your thinking, in terms of your control on your loans. This is more of a motivational strategy than the calculative one, but it works wonderful, right? I'll give you an example. Suppose list down like this. This format you can copy. You can take a screenshot of this, and this format you can copy. List down your loans, outstanding loans, like this, in this format. Loan type, balance, outstanding, interest per annum, whatever is the interest per annum, right? And the EMI. Now interest, this is 0.36 is basically percentage, 36%, 18%, 10% and 8%. And the EMI list down, right? Now, if you see the balance of credit card is the lowest, pay it off first. Don't think much. Don't, and if this kind of combo is there, like wherein the highest interest rate also has the lowest outstanding, amazing. You have cleared the interest loan first. You will find a very, very important thing in your life once you do this. You will find that little piece that is required, and then you can focus. And once you get this sense of achievement that yes, I have completed it, now I will set a target to complete the next loan, you will see that you are working towards it. Your mind is working towards it, and then things, your actions will support this thought process for sure. Knowingly or unknowingly, you will activate your subconscious mind here. But this is an amazing strategy. List down all your loans and then put a strategy in place for that, right? So take a screenshot if you want to do this. Now, refinance and restructuring. You have to understand what is refinancing and restructuring. Now, refinancing is basically transferring your existing loan to another bank. Basically, who are giving you lower interest rate or better terms, you need to find out that. Okay, check your existing loan and try to get a lower interest rate from some other bank. Basically, here the idea is to reduce the interest rate or shorten the tenure, but don't shift if the difference is not more than 0.75%. Only if it's 1% or 0.75% plus difference, then do this refinancing activity, because there are charges for refinancing. Yeah. So what is restructuring? Restructuring means changing the terms of your current loan with the same lender. There are two situations here. One, when the repayment is becoming very difficult for you due to some reason or the other, you go to the bank and you ask them to restructure your loan. Maybe reduce the EMI and increase the tenure for short term, and then you get that little cushioning, and then you bounce back. Second part is restructuring the loan when the interest rate, like in the home loan case where the floating rate has reduced, go to the bank, pay a nominal fee, and get your loan restructured. This second part, which I'm telling you, when the floating rate is reduced, check for this floating rate reduction every 2 to 3 years. It happens. Ask your bank, call up your bank, Baba, is there a scope for restructuring my loan? Is my loan is on the previous rate or the current floating rate? What is the current floating rate? What is the previous rate that I have gotten? Write down. Once you get this information, write down and ask the banker regularly. Type a SMS or write an email to them. They will respond. And if you see the rate has come down, and here there is no marker that it has to be 0.75% only. It can be even 0.10% reduce हुआ तो restructure करके लेने का, right? Now this is the overall benefit chart of refinancing and restructuring. So refinancing is good for lowering interest, right? Shorter tenure, you will get the benefit of lower EMI is something that you should look for refinancing. But no, not to prevent defaults. A lot of people do refinancing because I will get that 2 months of gap because the EMI of that new loan will start after some time. Don't do that, right? So overall, understand what is refinancing and restructuring. You can use refinancing and restructuring strategically to get out of loans, right? Now, loan is about the loan strategy. We get deeper into it. But one important aspect that actually affects most of the time the reason why we take a loan is because, especially the personal loan, some emergency comes in and we don't have cash, so we go and take a personal loan. Nowadays, personal loans are there pre-approved in the bank, account of yours. And they call you. "One lakh ka loan mil raha hai, 2 lakh ka loan mil raha hai. Take it." And what happens is you have that emergency and you feel forget that interest rate and all. I'll cover it up and I'll close this, in next 1.5 years. But again, you'll end up paying so much of interest. Instead of that, create an emergency plan. Always ensure that you have an emergency fund of 3 to 6 months of your expense. That liquid cash is going to help you to, how many people have borrowed expensive loans during COVID time, and it is continuing. So many loans are continued. So many relationships got spoiled. They, borrowed it from friends. And some people borrowed it from unorganized sector at a very high rate. Why to get into that? Build a 3 to 6 months of emergency expense. Start it with the liquid fund. Start a liquid fund, and do it in a SIP mode and build at 3 to 6 months of expense, liquidity for those managing those expenses. Another part is, we see a lot of people borrowing money because of health crisis. Please have a health insurance of minimum 5 lakh rupees. You either borrow money during that time, or you will end up breaking your investment that you have built over the last 4 or 5 years or 6 years, 10 years also. You have paid small SIPs, installments, and you have built 5-6 lakh rupees of fund over a period of 2-3 years. Suddenly, health crisis come in. Not only for you, it can be anyone who is dependent upon you for finance. It can be your dependent parents, it can be your dependent siblings, or other family members as well. And then what happens? You either lose all your savings, and the time that you have built up those savings, the time also is lost, or you'll end up borrowing. And at that point of time, most of the time when you borrow it, for such crisis, it is at a very high rate. So don't do that. This is something that needs to be avoided. Now, I'll give you a strategy, framework wise, I want your attention here. And I want you guys to take these strategies very seriously. I've told you about 4 ways how you can get out of loan or strategize, your loans in such a way that you can come out of it much faster, okay, and end up paying lesser interest. But overall, SIPs can work wonderful for those strategies. For example, I'll give you here. Okay, I told you about emergency fund so that you don't borrow more. Start a 5,000 rupees SIP. We'll put it in liquid fund. Time frame is 3 years, and then we'll put that money in liquid fund. Let it grow. If you don't need it, it will keep growing, at a nominal rate. But you will always have the liquidity. You will never have to borrow for some emergency. Start an SIP. Loan prepayment. I give you that same example. Where I said 5,000 rupees SIP and you build up 60,000 rupees. Okay, I'm saying make it a 7,000 rupees SIP. Put it again debt fund. Remove that amount after 1 year and put it as two extra installments. You are reducing your tenure, you are reducing your principal amount much faster, and you are paying much lesser interest. So if you have loan and if you think that you want to cover up two EMIs, that lump sum amount, if you think no, I will pay it once, that suddenly that 70,000-80,000 rupees lump sum amount, or if your EMI is 50,000 rupees, 1 lakh lump sum amount doesn't happen. But if you are slowly building up, a small fund for it through an SIP mode, at the end of the year, we will redeem that money and transfer it to your loan account. We'll assign a goal that this is only to reduce my loan tenure. And you see the magic happening. This is how you build long-term wealth, right? Now, credit card. Again, credit card. Most of the time you spend credit card for what reason? Many times when you don't have cash or there is a little cash crunch, you swipe the card. Why to have that cash crunch? Start an SIP. Call it a SIP for, as a credit card SIP. So instead of paying, taking credit, you use your own funds. Start a 3,000 rupees SIP. That is your credit card SIP. This is my credit card SIP. Even it can be 2,000 rupees SIP, not 3,000, 2,000 rupees. Let that money be there. Whenever I need it, I'll take it. Call it a credit card SIP. But this will help you to avoid a very high cost loan, right? Insurance premium. Many times, a lot of people swipe credit cards for their insurance premium because insurance premiums are huge. And, then those insurance premiums, you do have done it for your family, for your kids, for your retirement, for your term plan, for your dependents, right? And the amount is little higher. When you do it, probably you don't realize it, but then you get lot of other expenses sometimes comes in that same month, and you'll end up swiping your card. Why don't, instead of swiping that credit card, why don't you have an insurance premium SIP? All these names that I said, you can name your SIP as emergency fund SIP, loan premium payment SIP, credit card SIP, insurance premium SIP, right? And the last is, of course, you always have your long-term wealth SIPs that are there. But if you are able to have this, what is going to happen is loan prepayment will actually help you to reduce the tenure. More cash flow will be available with you, and the balance tenure you can invest more money and make more money. Credit card, you will never be able to, you will not fall into that debt. Insurance premium also, you don't have to, use some emergency source for funding that. You will also always have insurance emergency fund with you for whatever reasons. So if you are able to do this, I always suggest this 5 SIP. Yeah, one SIP for emergency fund, second SIP for loan prepayment fund if you have loans, third SIP, call it a credit card. So instead of taking a credit card, you start an SIP, right? You can have another SIP only to manage all your insurance premium, and of course, the traditional most important SIP to build long-term wealth has to continue. SIP can help you in a big way to get debt free, and whatever advice you need for that, we are always there. Okay. But discussing this with someone, finding solution for this problem is very important. A lot of people, okay, I have got it. A lot of people are into that trap of knowing and not doing. I might not be the first person who is telling you all these things. You must have heard it from before others, or, from others as well. But knowing and not doing is a bigger trap. A lot of people try to acquire knowledge. I know a lot of things, I've grasped it and I say, I will do it one day. I'll do it. I'll start. But that start never happens. I would request all of you to give us a call, give Yogesh a call, give me a call, give Pritam a call, right? Give Sushant a call. Okay. All team members are connected with, you guys, and start this SIP. Emergency fund SIP, loan premium payment SIP, credit card SIP, insurance premium SIP, and to build long-term wealth, right? And you will find your life much more peaceful, stable, and you will also find that you are growing your wealth for your future. And at present, you have much higher peace of mind, right? So Thank you very much. As we always say, be smart. Okay. And this time, I also want to say, be debt free. Right. Thank you very much. It is my pleasure to add value like we always do every month. Again, we will meet up next month with some another topic which would help you to understand your finances much better, which will help you to grow your wealth. Right. So a big thank you from BeSmart Wealth Management Company to all of you, and looking forward for servicing you and advising you so that you prosper and your family prosper. Thank you very much.